Hey, welcome everyone. Let's get going here. We got a long brief to get through. Turn on the camera. Here we are. All right. So we're going to be covering what's happening in the markets, which there's a lot of activity, especially yesterday and the day before, and a lot of whip around kind of action going on lately. But let's go through it all and make sense out of it. Got a few slides to go through. A little update for those that are new to Master Trader, or what how our approach is and how we do it. And so what we're after here is, what are these markets telling us? And how do we do it objectively, looking at the price action structure, intermarket relationships? So we're going to look at a few sectors, and what a divergence. I mean, I cannot remember. We'll take a look at them. Such vast divergences between what's going up and what's going down. And the whipsaws have been horrendous. And we'll get to that. So we need to understand the market environment, what's going on, put it in perspective. And the goal here is to be objective, meaning, we all have opinions. We look at whatever we're looking at. You may read things on YouTube, X, Facebook, some website, and so on, that maybe it's valid information, right? But you need your own approach to make sense out of it. So while that might be useful, how do you incorporate that into what you're doing and your method? And so as we do that, our approach is what I've coined techno-fundamentals. So what does that mean? Well, a lot of years ago, started out with, like everybody else, looking at charts. Maybe you looked at some fundamentals. I mean, I started to look at that and I was like, scratch my head as to making sense out of it. And, from there, looking at, the charts, and got into the indicator-based methodology. And the whole idea behind technical analysis is looking at pictures from the past, seeing how they're consistent or have a pretty good consistency, and we make assumptions about that pattern reproducing itself. Well, lo and behold, I found a lot of times that that didn't happen. And so understanding intermarket relationships, intermarket analysis was a big deal. And when you're starting out, you really don't know too much. Um, you got to try and figure it out. And back when I figured it out, there was no internet. So it was kind of more difficult than it is today. So we look at, this is stocks, options, ETF, put them in the context of what's happening. You could look at the news, and news is good, right? But you got to look at that and say, what do the charts say compared to that? And so from there, we can have our own biases to what's happening. So how do we do that? Well, in MT Live, and we've been doing them for quite a number of years now. You see this particular screen, which gives you an overview as to our approach. And within all of these sections, what I'd call thought building lessons, as you put them together, there are subsections of that, meaning, well, price is king, everything else is secondary. Well, now we have to explain price and how it moves in a very objective way. We look at it in the candlestick format with a price void. And so here I use this word that some of you might think, well, because it always happens. Well, what does that mean? And it's so interesting, because what's the definition of a void? Nothing. There's nothing there. And this was like a huge aha moment when I started out, because one of the hurdles that we all go through using technical analysis is a concept of support and resistance. And as you look at support and resistance and you get inundated with the indicator-based methodology, and you start looking at things like Fibonacci retracements and trend lines and volume weighted average price and speed lines and Gann lines and Elliott wave and so on and so forth. It leads to analysis paralysis. And it got so bad for me that fear. I don't know what the hell is going to happen. It was so bad that all of those, if you have horizontal lines on your chart connecting the whole numbers and the half numbers, it'll stop there. It'll stop at the moving average. It'll stop at this. It'll stop at that. And then I'd see prices go through those areas. And I'd be like, what the hell? How do you make sense out of all of this? And I was like, take it all off. Take it all off. And then the discovery of, hey, there's these things where there's no support and resistance. A gap? But what about momentum moves? And so these big momentum moves create voids. This is what we saw 2 days ago and yesterday. Voids, and prices trended into those voids aggressively. And so then it led to bar by bar analysis. I had to come up with a concept of how to not to be subjective, how to look at the charts without being caught up in the past too much, because the past is the past, it's done with. And then there's the present, and then there's the future. So as we formulate an opinion, well, how do I take the data that's coming to me right now and put it in the context of what happened in the past? Bar by bar analysis. Each bar has meaning, put in the context of what preceded it. And then, is there a void? So we put this all together, trend analysis. In there, we have to define trends. How do we do that? Put it all together. Multiple time frames, big, big, part of putting it all together and making sense, because one time frame doesn't match another time frame. It gets confusing. The support and resistance, relative strength and weakness, what's outperforming, what's underperforming. And like I said, there's such a wild divergence between the two right now, meaning software is in a bear market. It's going down, like it's not going to stop. Eventually it'll stop when it closes the void. Yet the transports are ripping to new all-time highs. And if you went back a year or so ago, they were always lagging. So things change. You need ways to continue updated information. Moving averages and volume secondary, we can use them. I'll explain. What are the broader markets doing? Internals we're going to look at, into market analysis. This is the big one, position and money management. Without this, you can't utilize this intelligently. Well, I can't say that. You could, but eventually you'll lose all your money anyway, because you're just going to be a rebel and you're not going to know what you're doing. So you got to have plans, just like for any business. And these two are connected to each other, psychology and your money management. Knowing money management and position management will allow you to free yourself from the fear of pressing the button and fear of missing out and so on and so forth. It takes a little time. And all of these, as it says, are not a trading strategy. So techno-fundamentals, and I created this little stool there, a three-legged stool, which, you're putting that all together and you got a nice solid foundation. You pull one out and things teeter or they fall off. Technical analysis is what we all do. We read the charts, support, resistance, trends, the lack thereof, into market analysis. What is oil doing? What are bonds doing? Commodities, and putting that all together. Internals, we're going to take a look at, breadth, sentiment, how do traders feel about the markets, and with all the internals there are to look at, and there's lots of them, boiling it down to breadth and sentiment, keeping it simple was so much easier, and the way to use enough information to make intelligent decisions without overdoing it. Lindsay's saying yesterday's prediction was a great advertisement for the course you sell, at least money management. Thank you, Lindsay. Yeah. So look, the courses are amazing. We'll talk about them a little bit, but you know, you think that someone makes a prediction and you think when it comes true, okay, they must, what a crystal ball. Well, you know what? None of us really know with ultimate certainty what's going to happen in the future. We look at what is. And one of the things I said yesterday, if you were there pre-market, I jokingly said, and I said it this morning because I had to reinforce my comments. Dan and I do a pre-market review every day. And so before the day started yesterday, the prior day was a big up day. And I assessed looking at intraday charts and which one of the four horsemen, as we call it, the S&Ps, the NASDAQ, the Dow, or the Russell might be the better one to trade. And so looking at that and the big up day, the opinion was that the Qs were the better one to trade because they had not a great void, but somewhat of a void. And I jokingly said, but what if it formed a big red bar today, which seemed so absurd? But I said it because the point was it would completely change our opinion. And lo and behold, it happened. But I thought that was the least possible scenario for yesterday. But as the markets opened and they rattled around there for a little while and then started to fall, and there was the void that was created the prior day, it opened up the door that had actually happening, and then it did. We'll take a look at that. So when we look at charts, let's put it in perspective. They're pictures of others' beliefs and expectations created with money. You boil it down, that's what we do. And so some of you that might look at a lot of indicators, Ichikumi clouds, and so on and so forth. I'll call you chart artist affectionately. But when you boil it down, we look at pictures. And what do those pictures display to us? What others have done. And what are they thinking? And that's why we call it candle language. So as we place trades, we can see what everyone else is doing. Now, that sounds easy. And as you bring things down to a very simple format, it is relatively easy. But that doesn't mean like things always go the way we thought. So you always have to have a couple of scenarios and stops, of course, in the money management. So these pictures, like these candles, bar by bar analysis, they continue to tell us what's happening on an ongoing basis. And what's better than that? For me, nothing. Now, this is what many will tell you you need to look at. I mean, there are people that sell courses on how to look at this nonsense. It's called an Ichikumi cloud, which theoretically it tells you where support is, resistance is, where to place a trade, what's happening in multiple time frames. It really sounds like a genius created this. But what they did was they made this colorful looking thing that covers the prices. And it covers what you really need to be looking at. Any perspective on PLTR, high valuation earnings, well, that's news. Earnings are news. And we look at the chart. So let me give you an analogy. Such and such firm comes out and says, XYZ is our latest, greatest idea, and it's undervalued. We've heard that how many times? And you then go and look at the chart, and you're like, oh, it's going down. And then you look at your stochastics with your MACD wrapped around an ultimate indicator, and you're like, yeah, that's oversold. And all of a sudden, not all of a sudden, maybe 3 weeks later, you see it's down another 20, 30%. And how did that happen if it was so undervalued? Well, institutions are still selling it. So when you ask me about PLTR, which was an amazing high flyer, institutions are now dumping it. So they loved it so much before, and now they hate it. Well, that's what happens, right? Environments change, technology changes. You need a way to change with it. And that's what our method does. It forces you to change with it. So let's simplify candlesticks. We got big candlesticks and little candlesticks. Call them what you want. There's a wide range of green bar and there's a wide range red bar. Define wide. Just look at the picture. Is it big compared to the other ones? Yes, it's wide. So here's narrow ones and narrow bodies, and they got little tails on them. And this tells me that there's slowing momentum, or momentum has come to a screeching halt. In the time frame that we're looking at, I'm going to show you a chart of what's happening in the markets now. It's going to be very interesting to compare the multiple time frames. So we're going to get to that. So bars change within the time frame that you're looking at on a daily chart. Like someone asked today in the green room about Amgen. And so it reported, I think it reported earnings, and it gapped up, and there was this big bar. It looks great, come out of a consolidation. Moving averages are relatively close to price action. It's not extended, and looks like it's going higher. And so I said just that, but the bar's not done. We've still got about 4 or 5 hours to go in the day. So we have to wait until later to make a decision. And the same thing applies if you're an intraday trader and you're looking at a 10 or a 15-minute chart, that bar's not done. So you need to keep track of the time. And so you could have a big green bar like this and it turns into a topping tail bar, which leads into the concept of retracements. I'll look at QCOM, we'll look at some live charts. So major point. If you're going to grab the mouse to place that trade and it's 12 o'clock and it's a green bar, wait until 3. And you may say, Greg, I listened and it kept going up and now I got to pay up more. But it's not a bottoming, not a topping tail bar. You know how many times that has saved us? Or just needing it to trade above a prior day's high to get long or below a prior day's low to get short. That little extra confirmation. So big red bars can become bottoming tail bars. So they made a turn, and that leads to multiple time frames. They make turns that lead to this becoming that. Where it happens, and says that's the key. Where that happens, because it can happen in the middle of nowhere, and that would explain why it failed. So you can scan this. We put this little QR thing in there. If you're on your phone, or grab your phone, just scan that. I won't explain to you why joining Master Trader. You can go and read the page there. So I'll give you a second to just, scan that. And on your phone, you just click the thing and it brings up the page and you can read it later, or you can just go to the website and there's a link there, Why Master Trader. So trading plans. Without a plan, you will almost fail for sure. It says guaranteed failure without a plan. If you leave yourself susceptible to your own thoughts in the middle of the trading day without a trading plan, well, you might get lucky. You might get lucky. Right? We call that finally a dirty Harry trade. You want to get lucky, punk? Hey, go trade without a plan, or just press the button without knowing what you're going to do next or why you press the button. We all need those plans to guide us during the trading day. That's our key. And so we put together that plan. As it says, traders often spend a little time to do that. Why? Because we're so anxious to make money. That's a good thing. That's why we're doing this. But you need to know why you're doing something. Why am I pressing the buy button at this particular time? Is the trend up, down, or sideways? If it's down, is it extended? If it's extended, is it on support? If it's extended and on support, did it form a bottoming tail bar? Did it form a W pattern? was there some price confirmation of actually making the turn? And if it's in an uptrend, is it on support? Is it on a moving average? How many things can I put together to put the odds in my favor? So technical analysis, and I already told you what we do. We look at pictures. And by looking at those pictures with other information like moving averages, technical analysis is nothing more than a self-fulfilling prophecy. Meaning, if you can get enough people to look at the same thing with a similar bias to act together, the trade will work. And then you need a way of continuing to monitor. That's bar by bar analysis. Yes, it's recorded. I don't social media, but if you are watching this, I have bought multiple Greg products over the years, including his most recent book, which is great, but Greg is sometimes wrong. Of course, we're all wrong sometimes. Thank you for that, Lindsay, which is why you need money. Yes, that's Lindsay saying that's why you need money management, right? None of us are right all the time, but you may go to some webinar and it's like, they're very convincing as to things. But look, not too many of these webinars you go to talk about money management. I don't know why. Anyway, this is something relatively new and it's growing. So Dan and I, like Dan posted a whole lot of symbols today, which of course, you look at those, you got to know what you're looking at. But we have a Telegram channel that's free. And, I posted a chart. I posted some videos there, some updates intraday, but you can scan that and you can access that. You don't even have to leave an email. And we give you some information, some videos, some ideas. And from there, you can decide if you like what we do, maybe join the green room or the advisory letter and so on. So you can scan that. I think Dan has dropped in the link to it, so you can check that out. All right, let's look at what's happening now. And I told you I'm going to show you two charts with the candlesticks in multiple time frames and how to interpret that. So on the left side here, this is part of a trend matrix that is in the ETF letter. So multiple time frame alignment is a big part of a successful trade. That's a starting point to creating a bias. So as we do that and we look at this every weekend, well, I look at this on a daily basis, weekly basis, and monthly basis for these time frames, but subscribers see this. And what they can see here is how this changes from week to week. So in this column is the current week. This was as of Monday when this letter was posted over the weekend. And this was the prior week. So you see the change from one week to the next. And the monthly, which doesn't change too often. It's a good thing. And then the weekly, this was the prior week, and this is the current week. And so as we look at this, if all these time frames are in alignment, this is green and the odds are in your favor. Now, if it changed that week, and I'll put a color, I'll color code this so it changed that week. Now you say, well, why is this blue on biotech? Well, because it first changed and I'm giving it a week to prove itself, but that changed. So these are up in multiple time frames and we can see the changes. And some will change from sideways to down, or from a really abrupt move could go from up to down or from down to up. And so when you get an abrupt change like that, historically, it continues to go. Now we can see software is down in the weekly and daily time frames. And in essence, this is telling subscribers, stay away from this. At least wait for the daily to change from down to sideways. And of course, then we'd be looking at the patterns to see what kind of pattern is forming there. Is it a W bottom? Is it going sideways for a while? Does it ignite out of a bottom with a bullish wide range bar? And so as we look at all of these, we can formulate our bias as to what's happening as it changes. So financials are a lighter green because the trend is down on the daily, but the monthly and the weekly are up. So what I will be looking for, and everyone will be, subscribers will look for is like from this down changes to sideways. What would change it to sideways? Well, we have rules for that. Part of our trading plan, a deep retracement, trading over an area of major support, which would lead us to a bias of buying a pullback. You can see consumer discretionary change from up to sideways, and it was all green before. And so as that happens, and there was news, not necessarily trading on news, but it's interesting how the news comes out. This morning, I saw go across the ticker, consumers are holding back on their purchases. So how long have we heard that the consumer is what's holding the economy together, and the idea of the soft landing and so on and so forth? Well, now consumers are withdrawing, and this idea that the economy is doing so well, it's certainly improved as of late, and over the last 6 to 9 months, things have gotten better. But prior to that, the prior administration, and they don't want to admit it, but that was a recession that was going on. And so there was a lot of deterioration under the hood. But again, through here, we can see the overall health of the broader markets and how it changes. Energy now is doing well. Industrials are doing well. Overall, things are good. There are times where you're going to see a sea of red on here. So you just look at that and it's like, things are not good. And when they hear, you can see things changing. Healthcare changed from up to sideways. This one went from sideways to down. So healthcare, so we can see pretty quick how money is beginning to rotate. Now, here's our market internals. This is breadth, and this is sentiment, put call ratios. This is equity put call ratios, which there was a lot of optimism growing over here. A lot of call buying in equities got to an extreme, and breadth is deteriorating. And this one here, this is the total put call ratio, which has not reached an extreme. It's neutral. And we look for alignment of breadth and sentiment to help time what's happening in the broader markets. And so I captured this before we came on here. And you see, there's the big up day from 2 days ago. Then yesterday's big down day. And today is just trading inside. It's rotating down. I'm just peeking over to my right there to see the other charts, and things are rotating lower. And looks like S&Ps are coming down. They are down near yesterday's low. So right now, this chart, it's down here where there'll be some support. Yesterday's low. So a prior day's low is our first reference point of support. Here's the daily chart, and here's the weekly chart. Now, look at that daily chart and look at the weekly chart. What do they communicate to you? Remember, we said there are wide bars, there's narrow bars, there's bottoming tail bars, topping tail bars. Right, Robert's saying that they're overlapping. Now, the daily is overlapping and the weekly is overlapping. And so when we hear, you might hear, oh, the market is in a bull market. And, all these positives. Well, you know what? When I look at this weekly chart, what I see is the market hasn't budged in weeks. It just whips up and down. Breaks out, it breaks down, goes back up, it comes back down. Now, if you agree that charts are pictures that represent the beliefs of other participants, regardless of who they are, hedge fund, money manager, retail trader, prop trader, what these charts communicate based on this S&P 500 is that the majority are confused. Why? Call it the Trump effect. So whether you love him or you hate him or you're indifferent to him, he's having a major effect on changing things. There are lots of opinions. Whether it's good, is it bad? But what we see here, which is to our benefit, is to recognize the confusion rather than us having some strong opinion based on, well, whatever that might be. I look at these charts and I say the S&P 500 has just been marking sideways. Look at the opens and closes close together here. Here it dipped down, and here's another reinforcement of don't assume the close of the bar. Meaning this bar on Wednesday could have been a big red bar, and you think, oh, I better get short. It's going down, and you short it. And on Friday, it's a bottoming tail bar, and you recognize a bottoming tail bar versus a big red bar. What do? I don't know. You know how many times I've gotten an email years ago, a phone call, and say, Greg, I did such and such. And I'd be like, why'd you do it? Well, you know, it was a down bar. I said, but yeah, but now it's not. Anyway, we have to have rules that stop us. And I say this in a very frank way. We need rules to protect us from ourselves. Fear and greed are powerful emotions, and we need those rules. And unfortunately, I can't save you from yourself. Only you can do that, because you know what? You're going to break the rules. And I can make the analogy, how many times you want to put your hand on the hot stove before you realize it hurts? And that's what breaking the rules are in the market does. You lose money. And if you lose enough money, you're out of the game. So you got to start off trading small. All right. Memberships. You can scan this as well. I think Dan had already dropped in the link, but the weekly options trader, which I'll give you a little view. I can drag this down here. This was last week's advisory letter. And so you can see, it's pretty extensive with an overview of what happened. And there'll be other charts. So I was showing the software ETF that was in a bear market, talked about inflation, what the Fed is doing, oil, different levels. And I pointed out not everything is bullish. Well, I point out the good, also have to point out what's not so good. And I talked about the cryptos and how it was breaking down and how that could affect the broader markets. Different levels to look at. January effect, seasonality, volatility, and so on. And review of the S&P 500 charts on daily and weekly time frame. This is another quick overview of what's happening across those sectors and what's happening. What's the bias for next week? Right? Put little tips in there of what's happening, levels to keep track of, update on the internals, some earnings that are coming out. This is an educational chart that I do each week on the Dow, explaining that. This was a connection to something educational. There's a video you can see. It's about 20, 25 minutes long about what's happening there. And then, you got your trade recommendations down below, swing trades, and option trades. And Dan put this in for the weekly options trader. And so that was the performance for that. And here you can see the weekly options trader, the recommendations that are explained. And these are just weekly credit spreads and so on. All right. Let's move on. All right. Trading education, you can scan that one and share the link. Would you make more shorts, trade reviews of yours. Trade reviews. I dropped a link yesterday. I did a video on a trade, and I did that. I don't know if you saw it, but in the green room, when they said, "Hey, Greg, record that. This sounds like good stuff. Record that." And that was trade yesterday afternoon. All right, so let's look at what's happening in the broader markets. Take that down, take this down, and take a look at what's happening in some stocks of interest. Okay. So this was that thing I showed you from the letter. And this updates, well, for me, it updates in real time, of course, but S&P sectors, and I sort this each week by weekly percent change, but we can sort this by what's happening today. Right? And so we see, where is the money going into today? It continues to go into energy. And this was the worst performing sector, right, last year. 2 years ago, it was the best. And so now this is broken out. Let me show you this on a weekly time frame because it implies it's going much higher. That's new all-time highs. So you can see at a glance, we can see it's above the 20. This was last week. It was above the 20. So another way of, this is in the advisory letter and the ETF letter. But we can see what happens from week to week as it's changing. So this one here, well, they were both 2 weeks in a row below the 20 MA communications. I'm looking for one that changes. This one here, so this is updating in real time. Consumer discretionary. And I said before about discretionary, the news that was coming out. So this is breaking down. Look at this chart. You recognize that? This is not a bullish chart. That's a head and shoulders top. And if the consumer is backing off, which this chart says it is, and it breaks this neckline, this is a void, folks. That momentum move, and there's nothing to stop this from going down. So theoretically, it could come all the way down there. And if that's the case, the broader markets are likely to go down. So we're going to take a look at that. Let me get rid of this. But what we could do is, this is part of the top-down approach, is to now go and look at the stocks within that particular sector to see what's doing well and what's not. We can see what's showing relative strength or not. And we can sort that by day, week, year, quarter. These are scans within the minder, meaning this one here tells me it's near the 20 and 50 MA. Now, I got to go look at the chart. It's near the 20 and 50 MA, but it broke down and it's advanced all the way up in here. And this weekly bar is not done yet. Today's Wednesday, and it's not even 1 o'clock. So I don't know that this bar is going to look like this at 4 o'clock. And on Friday, this could be a red bar, or it might close this way, which would mean it would have to go sideways for a couple of days or keep going up if that bar was going to grow. So the retracement here is decent, coming back from that kind of a breakdown. I wouldn't have thought that it would come back because that broke down pretty sharply. And this is the void, the way it came down. And you really have to respect it. Two things. The void communicates momentum and power. And it infers that prices are going to continue to go in that direction. But it also puts a big hole in the chart. You can see the 65-minute chart here. That decline, lower highs and lower lows. It begins to bottom and it starts going up like that. I don't know why. Probably some news came out. I don't know if it reported earnings. It's going to report earnings. You can see here at the end of this month. So it didn't report earnings. Nonetheless, buyers came in and pushed it up. So we can look at different scans. I could look at, is it a bullish wide range bar? We can sort these here by bullish bars, and we can find things that are, you know, big bars like that. And again, this isn't done, but what would I do with something like this? It's not a directional. I can see the moving averages. I call them visual aids, are intersecting the prices. So I'm not going to buy this as a directional trade, but this is something that maybe if there was premium, we would consider this for a put spread, right? A credit spread. So it has started to go up. Credit spreads are the easiest thing in the world to understand. They're not so easy to manage, meaning because the attraction is, look, if it just doesn't go down there, you get to keep the money. But if it threatens to go down there, you don't want to see a max loss. And so, but we would look at this and say, you know what? I'd look at an option table and say, is there premium down below $200? And if there is, we could do a credit spread betting that it's not going to go down there. And we'd have to look at the time to expiration, and the shorter the time to expiration, the better. And then earnings on the 18th, that has to be considered as part of the checklist. What sector is it in? And so on. So as we go through that, now we come to some conclusion as to, do I want to trade this directionally? Do I want to do a credit spread? Maybe you want to do an iron condor. You're like, what is that? That's just two credit spreads, a bullish one and a bearish one. And I think it's going to stay in the middle of the range. And a picture like this where the moving averages are intersecting prices tend to be pretty good. Starting point for, could be definitely a credit spread, but maybe even an iron condor. Lindsay is saying this is her final post ever. MT Live. If you are new to trading, Greg is the most honest person you will find. If you think that means trading is easy, it isn't. Hence, what if I'm wrong? Thank you, Lindsay. Well, don't make it your last on MT Live post, but thank you. And so we don't pay Lindsay to post to say that, but all right. So look, as we go through this, what's happening in the broader markets, on the day, on the week, on the month, and so on, and we review this in the letters. So as of today, energy is doing the best. What's doing the worst? Technology. If you were in MT Live 2 weeks ago, or in the letters and pre-market review, I talked about not the trend lines. I said volatility is contracting. And I just used the lines to display that. As the pivot highs and the pivot lows are getting closer together, that means the spring is coiling, and it's going to break one way or the other. Because what this communicates is that there's a tremendous difference in opinion. I'll spread it out a little bit. The majority are bullish. 20s rising, the 50s rising, the 200 was rising, the red line down there. It whipped down, it whipped up. And so others think it's going to continue going up. They bought it here. Others think it's going to go down. And it pivots. 3 higher lows to the left and right. And so now it starts tightening up. It's tightening up. And, market environments change. And this one, I often say that bottoming charts are treacherous because they whip around. This market is a bit treacherous. And I'll call it the Trump effect. I voted for him. I like some of the things he's doing. Some of the things he's making everybody crazy. So that's just my opinion. Have to be objective, just like with trading. But it broke down and then it stopped. It didn't even come down to support. Because we look at things like this. Right? We look at them. I can drag this. I'm trying. We look at things horizontally. So when prices break down below pivots, it creates a thought. It's going to go down to the next pivot and maybe keep going. Well, it just stopped. This is the market environment we're dealing with. And it ripped right back up and it takes out the highs. So here You know, Greg's doing pre-market review. We're in a letter, and it's like, oh, technology broke down. It's going to go lower. A few days later, Greg's saying, oh, technology is going up. It broke out. It's going to go higher. Is Greg losing his mind? No, he's just following the charts. That's what they communicate. And now it's back down again. And so this is a situation where it's normal to become apprehensive of trading because I'm going to get whipsawed again. Well, we didn't get whipsawed because we didn't have any confirmation, and I'll show you why. As this flipped green up, it was like, okay, if it trades below here, that's a continuation pattern. We'll short it. It never triggered. It saved us. Here, we don't buy greater than 100% retracement. We buy pullbacks with the appropriate pattern, and there never was one. That's bar by bar analysis, keeping us out of trouble. And now here's a wide range bar, and it breaks down. How am I going to get on board that? Well, multiple time frames. I can expand the data to get on board that, define an entry, like on a 65-minute chart, something like this. Or I just may miss the trade because it didn't give me an entry point. Usually we look for like 1, 2, 3s or 1, 2, 3, 4 patterns. That's not happening. So at this point, it's reasonable to say that the uncertainty is over. Now they're in agreement. Get the hell out. Someone yelled fire and it's being dumped. And so from that point, well, what's being dumped? The strongest sector in technology is being dumped now. And this is part of what happens in a market cycle where things that are doing bad, they begin to accelerate lower like this. Notice this bar. What do you look at this bar, everybody? Compare today's range to that range. What's the difference? What's the difference between this bar and this bar? It's not a trick question because everything we look at things to be, it's obvious. It's a narrow range. This bar is narrower in range than the semiconductor bar. It's a wide range bar and it's on the rising 50-day moving average. Semiconductors are being dumped. And so often within a correction, it gets closer to the end when the strong ones get dumped. Now, that doesn't mean it's over. It just means that now institutions are selling their winners. They're really nervous and scared now. And so we're going to, tomorrow and over the weekend, we're going to go look our internals. I want to see them buying a whole lot of put options and they're scared to death betting that it's going to crash. But now when we go to the software sector and I see a narrow range bar, and look at that volume down there. Even while the volume is secondary, it's exploding. Is it near support? We have to look to the left. Not yet. Not yet. I'm thinking it's going to get down there. Why shouldn't I think that? That's where it is. Right? So if it gets down there, what's going to happen is, mark my words, it gets down there, software stocks are going to start getting to be bought, even while the semiconductors are still being sold, because money will start to rotate into these losers. Which is the biggest losers? Well, let's look at, we could look year to date and sort it by what's negative. And we see this Intap getting killed. It's not on support yet. It's already fallen as of today, 55, 56%. This is what happens when a market is correcting. You think, oh, the market's only down 3 to 5%. Well, you know what? A lot of times you're going to find things that are down 30, 40, 50%. That's why if you don't have a money management, position management plan, you're going to be in trouble. So we can just go and look at these. And within this sector, you're just going to see things that are being destroyed. Right? Destroyed. Bear market. Which one? Are there any that are up that are showing relative strength? That one's a buyout. But now look, the strongest are now getting sold. That means we're getting closer to the bottom. Doesn't mean it's here right now, but that's what you want to see, that the ones that are showing strength start getting killed. All right. So software getting killed. We looked at technology, which is a very broad ETF, and then we looked inside of technology and we looked at semiconductors, and then we looked at the weakest, which was software. And there are other sectors within there as well. Another screen for that. And by the way, when you become a member, either in the green room, in a letter, become a student, if you use this platform, we will share these layouts with you. And I've got, different ones. It comes with being a member at Master Trader. We can share these with you. All right. So again, within these, we could look at any of the sectors, like consumer discretionary. I showed you, looks like it's going to break down there and do the same thing. What's doing the best today? This gapped up. People are going to casinos. Right? So consumer discretionary is starting to roll over. They're doing well. People haven't been buying too many sneakers. You can see Nike. Starbucks is making a turnaround. There was a news about them using robotics or AI. As amazing as AI is, a lot of people are losing their jobs, and that's why software is getting destroyed. The software sector, AI is taking a lot of jobs. But I don't know about people's, consumers backing off. I don't know about people going back to buy $4 coffee, but cup of coffee, whatever it is, haven't been there in a while. But technically, this is making an improvement. And look at the moving averages, how this is just coming out of that. So this is starting to make a turn there. And this is the factory work. Interestingly, residential construction and home builders. That's it, they call it the Trump effect. But, he made some law. I don't know if it's a law, but institutions can't buy individual homes, and it skyrocketed this off of a low. And so now that's pulling back. It's under the moving averages. It's whipping up and down. So there's still a lot of uncertainty there, but it leads us to our intermarket analysis of interest rates. Interest rates are starting to turn up. Why are interest rates going up? You see the ISM number? It was the biggest change in a long, long time. So not that we feel so confident with the government's numbers, but they are what they are. We have to go with. And that implies that the economy is growing and there's growth. So interest rates start going up when there's a demand for money. It also goes up when there's inflation. And so there's this balancing act there. Oil went up quite a bit. Venezuela, Trump effect. And we're keeping an eye on this, what these interest rates do. And then there's always the talk about the Fed. Well, we have the greatest indicator that there is. You don't need the CME watch tool. I've used this for decades. And you can go back. If you're an advisory letter subscriber, go back and look at what I wrote over here in 2022. I said, this is going to be a problem. Interest rates were down low here near zero for the longest time. And this thing turned up, like it's going to be bad. And so when it rolled over, things started to improve. And of course, we look at yield curves and other things, but um, now interest rates have stabilized. And I suspect that all of this conversation about changing the Fed chairman and Trump was talking to others and what he's going to pick. And, economic data comes out, of course, but look, this started going sideways and started inching up a little bit. And so I mentioned in the letter, and I mentioned, pre-market, if we look at this, I said, they're not going to cut. I don't need to go to some Fed advisory letter or whatever. This here is going to tell you what the Fed is going to do. It's been so consistent over the years. That's all you need. Now, that CME watch tool is a pretty cool thing. You go to that cmewatchtool.com or whatever it is, and they give, biases of what Fed governors are, what are they going to vote or what they might do. But this is as accurate as anything you're going to find. Is it trending down? Is it trending up? Is it bottoming? Right? Is it topping? It's kind of grinding up there like that. Very, very reliable. And of course, we look at other sectors. Now look at what happened today. Another red bar in the Russell. Yeah, it's short-term extended. Looks like now it's got to go down to the 50. And so it's just another picture of uncertainty. And it couldn't take out the highs, and now it's back down again. Here's the Qs coming down here. So going back to the green room when this is done, I'm thinking this is at a whole number. I would take a look at, I don't know if I have this on here. I have one on here. Look, options. Where is the biggest open interest in volume? Look at, all right, so here's volume, open interest volume, and it's well through 610, but it's coming to the whole number. And a large open interest in volume down. Look at the difference between 600 and 605, 602. That leads more information to that whole number based on this option data here of being a decent support area. So what we want to do is the same thing we did yesterday in the S&Ps when they went down to the 50 MA, is to now, with a bias of the higher time frame and this options information, would be the NQ's got, well, that's because it's futures, Damos. Futures traders usually overdo it. And so here's a guideline that I've used. And don't use the futures market or a leveraged instrument as your guide as to your bias. Use the underlying. Futures and leveraged instruments will move further than the underlying. And so it's not a good guide. I'm not telling you not to look at it, but your ultimate piece of information is the underlying, not the leveraged instrument. So if we were to look at TQQQ, which is the leveraged ETF, you see it's broken down through it. Don't care. This is coming down to the pivot low. That's where the buyer showed up before. It's coming down to a whole number. So now you can then go and look at the 5-minute chart, multiple time frame analysis, and you can see it's beginning to bottom there. Now, yesterday, that video that I did, we looked at the NYSE tick. I don't have time to go into the tick, but that's something that we would be reviewing again. Right? Yesterday, you heard for the first time trader pivot lines. Yes. So trader pivot lines are a subjective reference tool. And I'll show you this, make a big chart here, and we can put that on there. And the good thing about trader pivot lines, again, use it on the underlying. We go here, an indicator, and go down to pivots. Pivots, right? Pivot points. And you look at, well, there's another thing. There's a trader pivot line just above 600. There are going to be bids there. I use the analogy, traders are going to bid at these pivot lines like Pavlov's dog when he rang the bell and they salivate. You can count on there's going to be bids there. That's part of what I explained in the video. So coming down into this area you have a convergence of information coming together. I'll throw this on a 15-minute chart to condense it a little bit, or maybe a 65-minute. Now, as it comes down into this area, this pivot is whole number, trader pivot line, options activity, buyers are here and they're going to buy, and it's extended, and the probability is it's going to bounce. How far? I have no idea. I just have a belief that it's going to bounce. And so as I go down to this smaller time frame, a retest and reversal could be an entry point. No, every platform should have this. There's nothing proprietary about this. I have a NinjaTrader platform. It's on there. TC2000, not TradeStation has it. Thinkorswim has it. They all have it. I don't have Bitcoin on there, but I can look at GBTC, and then we're going to call it a day here. As we're past 1 o'clock, I got to get back to the green room. Bitcoin is crashing. It's into the void. It's in trouble. People, Bitcoin people, they're like a cult. So at this point, I think they're starting to throw in the towel. You can forget the pivot lines. It's slicing through that like a hot knife through butter. And weekly chart, it doesn't look good. Right? It does not look good. So that's a big top. Ethereum's going down. We can get into gold and so on. But look, we will be doing another one of these briefings in a couple of weeks. We'll send you out the link. If you liked it, hit the like button. Give us a thumbs up on social media. Check out the education and the courses. And we'll be back. If you have questions, email us, Greg and Dan at Master Trader. All right. Have a great day. Bye-bye.